Good afternoon, everyone. When we entered FY15, we were faced with multiple challenges. We had below industry growth, our margins were declining, there were leadership changes, leadership attrition, low employee morale because of lower variable pay to employees, fewer promotions. In the last 1 year, your company has put a lot of these things behind and is now fully focused on delivering the vision of 2020, which Vishal just spoke about in his address. During the year, our revenues grew by 6.4% in rupee terms and 5.6% in US dollar terms. We delivered a 15.8% growth in EPS, one of the best in the industry. This is after having invested in multiple employee initiatives. During the year, we reinforced our commitment to employees through various initiatives. We increased variable payout from 64% to 86%, announced quarterly promotion. We are probably one of the only companies in the country to give quarterly promotions to our employees. Promoted 25,000 employees during the year, compensation reviews in line with the market. We also did a mid-year increase for employees because of the skill set mismatch. We also increased employee engagement activities, including training. We trained over 25,000 employees in design thinking initiatives that Vishal mentioned in addition to the normal training activities. In spite of all of that, we were able to improve our operating margins by 190 basis points. A lot of this was possible because of the operational efficiency that we showed during the year. Our utilization, excluding trainees, was over 80%, the highest in 11 years. Our offshore effort mix was over 70%, the highest in the last 4 years. Employee addition of 53,386 employees gross and 15,782 net. 221 employees added during the 221 clients added during the year. We also made a few strategic acquisitions and investments during the year. We acquired Panaya for US $225 million. Panaya is a leading provider of automation technology for enterprise software management. Panaya will enable us to enhance the competitiveness and productivity of our current services by leveraging technology. We also closed the acquisition of Scava for US $120 million. Scava is a leading provider of digital experience solutions, including mobile commerce and in-store shopping experience for large retailers. Our cash and cash equivalents were 32,585 crores as at March 31, 2015. We also articulated our capital allocation philosophy, which led to the dividend payout increase from 40% to 50%. A year back, this was about 30%. So in the last year and a half, we have been able to increase our dividend payout from 30 to 40 to 50%. As Vishal mentioned, we also announced 1:1 bonus in October, which was effective in December and in June. If you look at summary financial performance, our gross profit grew by 12.8% in US dollar terms and 13.6% in rupee terms. Our net profit up by 15.8%, EPS growth of 15.8% in rupee terms. USD INR average rate didn't change much, though there was a lot of volatility in the currencies during the later part of the year. Our balance sheet of 66,352 crores, cash and cash equivalents of 31,241. Trade receivables almost at 15% of the balance sheet size. So if you look at this balance sheet, we have almost 55,000 crores in shareholders' equity. Debt-free, it's one of the best balance sheets that you'll probably see in any company. We continue to balance liquidity and return. We had set ourselves a threshold of at least 2 times the cost of capital for return on capital employed and 3 times the cost of capital for return on invested capital. Our ROCE is today at 2.6 times the cost of capital, and ROIC is at 4.4 times. Our ROIC is 61.1%. Dividend increase, if you look at it in FY13, it was 30%. Last year increased to 40%, and this year up to 50%. We saw broad-based growth. We saw growth across all our verticals and our geography segments. Manufacturing grew by 8.1%. Energy, utilities, and communication services grew by 8.2%. Retail continues to see some challenges at 4% growth. North America grew by 8%. Europe growth was slightly muted because of cross-currency impacts that we took during the later part of the year. This was one of the important metrics that Mr. Murthy had set out for us when he came back, that the employee cost as a percent of revenue has to continue declining, and we have to become more and more efficient in the way we do things. And that we demonstrated through increased utilization, bringing on the offshore mix, And employee cost has come down from 61.4% in FY14 to 59.9%, including subcontractors, and from 57.5% to 55.8% during the year. Our volume growth of 9.3% overall, but if you look at the offshore volume growth, it was 12.1%, probably the highest that we've seen in the last 3 years. The on-site volume growth was 2.9%. Two reasons. One is because of the, the slowness that we saw in terms of start of project, but also because of our initiative to bring back work offshore. And our offshore mix has actually improved by almost 250 basis points during the year. Realization continues to be a challenge. The traditional business is seeing a lot of pricing challenges, a lot of commoditization, and this is something that what Vishal articulated in terms of renew is targeted towards. The renew and new strategy would help us improve our realizations per employee, and that is what Vishal has set out as 80,000 as target for 2020. Utilization of 80.9%, as I said, the highest in the last 11 years. The offshore mix of 71.2%, the highest in the last 4 years. Other income of 2,892 crores, up from 2,380. Exchange gain of 475 crores. We continue to have about $1 billion of hedges. We have seen a lot of volatility in the currency markets. We believe that our strategy of taking short-term hedges has paid good dividends in the past, and we continue to follow the same strategy. We continue to hedge for short terms. We hedge for about 2 quarters of net assets, and we will continue to do that. The global currencies were very volatile. If you look at the later part of the year, we get about 69% of revenues in US dollars, about 7.6% in Australian dollars, and about 10.2% in euros. The average rate, if you look at it, other than the USD INR, the USD actually appreciated against Australian dollar by about 6.5% on an average, against euro by 6.7%. However, if you look at the period end volatility, and this is what impacted the reported numbers and our guidance for the next year, if you look at it, the GBP actually has moved down from 1.7 to 1.48 from Q1 of FY15 to Q4 of FY15. The euro from 1.37 to 1.08. And if you look at AUD, from 0.94 to 0.76. This impacts the reported revenue growth for the company because when you bill the client in any of these currencies, when you transfer into dollars, you use the latest exchange rate, which starts impacting the reported numbers. However, though all the US dollar was appreciating against all the currencies, against the US dollar, it was very, very volatile. So if you look at the movement against US dollar, it has actually been stable over the last couple of months, but it has been highly volatile against the US dollar, against the INR against the US dollar. Because of the volatility that you're seeing, we gave a constant currency guidance of 10 to 12%, which in reported basis would mean 6.2 to 8.2. As of March 31st rate, there was an impact of 3.8% on the growth because of cross-currency movement that I just spoke about in the previous slide. In INR revenue terms, that will be a growth of 8.4 to 10.4. And as it was articulated by Mr. Murthy and reiterated by us, we expect to grow in line with the industry in next financial year, in FY17. Thank you.